Generally, in the finance term, hedging means to say managing your risk. When you hedge your position, you are trying to manage the risk of your position. Let's use back the concept of futures, for instance. Now, assuming that you need to use crude oil in your business, so you have to buy crude oil constantly to actually produce what you need to produce. Then you're worried that oil price will actually move up. That's when you get into a futures contract to lock in the price of the oil so that you manage the cost, or you can actually stabilize your cost. This kind of process we call it is a hedging. You're actually hedging your risk. But when you use the terminology of hedge funds, it doesn't mean managing risk. In fact, it could be the total opposite direction. Hedge funds is not about managing risk, but hedge fund is about taking bets or taking high risk bets on things that the firm or the fund believes in. The most classic example was, of course, George Soros' quantum fund, where in the 1990s, they actually bet against the pound sterling, where they actually believe the pound sterling will actually lose its value, and they actually bet heavily against it. So the counterparty was actually the British government. So of course, in the end, the quantum fund make the right call, make the right bet, and they actually reap billions in profit. So basically, that is what hedge fund is about. As to what they will actually invest in or bet against, they can be betting against a currency or for a currency, can be betting against commodities, anything. It's basically anything where they can actually take advantage, where they foresee a trend to be in their favor and bet on that trend.